Let's get across the market opening. Kyle Ryder joining us from Capital.com. Kyle, happy Monday to you as we get going this week. Let's start with what we saw on Friday, particularly Wall Street. In fact, rounding out another month of gains, in fact, 7 in a row that we've seen now on Wall Street.
Yeah, pretty much since the April lows, we've seen one direction travel for the S&P 500, Wall Street more broadly speaking. And I think ultimately the news flow last week was relatively mixed, but it was enough to kind of obviously keep sentiment reasonably well supported. There's still the narrative there that earnings is solid, although questions persist about valuations. US-China trade tensions are more or less put to one side. I think, investors were maybe looking for a little bit more out of the deal that was sort of mooted, but, got enough to really feel confident that maybe this is something that, will diminish uncertainty in the markets. Then there's obviously the question going forward of Fed policy, and there's sort of some doubts about the aggressiveness or steepness of the future rate cutting cycle, but there's still a degree of confidence there as well that rates will be cut. As I sort of assess it at the moment, we don't have that many obstacles sort of in the week ahead necessarily now until we get some more data, which may not come out because of the US government shutdown. Nvidia results aren't for a couple of weeks. So there's sort of a little bit of open road for the markets. The kind of question is, and I think you saw this at the back end of last week and certainly in Friday's session, is that maybe some of the momentum driving the market is petering out as well. So it becomes kind of a question of whether, with the absence of event risk in the week ahead and that kind of vacuum that might appear, all else being equal, stocks continue to run higher, or whether, we've climbed the wall of worry, there's not much momentum there and we start to, maybe even pull back. So it should be an interesting start to the week, one that should be sort of fairly, muted. But nevertheless, the week's news flow last week was overall positive, although, still, mixed in some respects.
Well, certainly a lot of Fed commentary at the moment, particularly those that voted against a rate cut coming out and justifying why that's their position.
Yeah, and I think, there is the sense that there is, even though a consensus, or there was a consensus on the FOMC last week that rates needed to be cut, that there needs to be more optionality, more or less, that the Fed is giving itself, especially going into that December meeting. And of course, the comment there from Powell last week was that a rate cut in December is not a foregone conclusion. And I think that sort of illustrates that there is, still a bit of doubt about what's leading to this slowdown in the US labor market. And the cause of that is still a bit of a point of contention, whether it's actually more of a supply side dynamic due to, say, immigration policies. Maybe there's something to do with, artificial intelligence in there, or is there genuinely an economic slowdown going on in the States that's affecting hiring? Obviously in that situation, if the Fed feels, quite inclined to cut interest rates, the other side of that too, with or I should say the other side of their mandate, is that inflation is still well above target and possibly moving away from target. And although there is the sense that the balance of risks are still sort of skewed towards a weaker labour market, and that's what the Fed should be focused on, it doesn't want to box itself into a corner with a market that's effectively, as a couple of weeks ago, pricing in completely a December rate cut. So there is that sense that they're trying to shift market pricing a little bit, give themselves maximum optionality, and really try to contain the risk that inflation is going to continue to move away. That maybe even we could end up in a bit of a stagflationary mix, and that the proverbial punch bowl is being moved away from the markets as well, which have rallied so aggressively on these rate cut expectations. So again, going into the next couple of weeks, we're already seeing the rates curve shift a little bit. Equity prices have responded to that very slightly, but not meaningfully. So if there's one thing that may be a bit of a might sort of hamstring the market a little bit, is if we do see those rate cuts coming out of the market, and valuations kind of responding accordingly by sort of resetting lower just marginally.
Yeah, and as you mentioned, certainly the key data this week out of the States are those jobs figures. Kyle, let's turn our attention to what we're seeing locally. Now, of course, the rate decision tomorrow from the RBA. Now, any chance of a cut has certainly been priced out.
Yes, and the narrative shifted again in the opposite direction. Obviously we've had a bit of a whipsawing effect in that regard, where the CPI indicator data that we got through August and September, or whatever the months were, it might have been July or August, showed signs that inflation was moving in the wrong direction. And that sort of view, for the hawks anyway, was sort of vindicated by the official figures that we got last week, offsetting obviously that very brief period where everyone was quite focused on the labour market and the signs of deterioration that we're seeing there. It's starting to look like a pretty scary and sort of potentially invidious mix for the RBA, which is now dealing with an unemployment rate that could be ticking higher, as well as an inflation rate an underlying inflation rate that is ticking higher as well. And so the commentary around effectively the RBA's reaction function tomorrow is going to be really interesting. Will it continue to cut rates if the unemployment rate climbs to 4.6%, even if it just stays at 4.5% or thereabouts? Or will they be more focused on, their price stability mandate and say, well, we're willing to accept this kind of weakness in the labour market if it means that we're going to keep price stability and inflation under control. So it's a pretty precarious one, but the notion of any kind of rate cuts is pretty much off the table for this year now. Again, that next labour market print will be interesting, but we've got pretty much the market's not pricing in any cut until the first quarter of next year, if that. So it's really a dynamic that's not very good for the markets at all, and is likely to see us sort of underperform our global peers just on the basis that they're cutting, we're not, even as our economy remains relatively sluggish.